Governments do not sell ownership. That sentence sounds simple, but it explains almost everything that follows. When a company needs money, it can sell shares. It gives up a piece of itself in exchange for capital. Governments can't do that. There is no stock market for sovereignty, no dividend on citizenship, no dilution of control. And yet, governments still need money, constantly. To build roads, to pay soldiers, teachers, doctors. To respond to crises, to function at scale. So if they can't sell ownership, what do they sell? They sell promises. That promise is called a bond. At its core, a bond is just a loan. An investor gives money to a government today, and the government agrees to pay that money back in the future, with interest. That's it. No ownership, no voting rights, no control. Just time. And time is exactly what governments value the most. Think about the alternatives. A government can raise money in three main ways. It can tax, it can print money, or it can borrow. Taxes are visible, they are immediate, they are politically painful. Printing money is quiet at first, but destructive if overused. It erodes trust and purchasing power. Borrowing sits in between. It brings money now, pushes cost into the future, and spreads that cost across generations. Bonds allow governments to fund the needs of today without forcing today's voters to fully pay for them. That is why they are loved. Not emotionally, structurally. So, how does a bond actually work? When a government issues a bond, it defines a few things upfront. First, the principal, that is the amount being borrowed. Second, is the interest, often called the coupon. That is the repayment made to the bondholder, usually once or twice a year. And third, the maturity. That is the date when the loan ends and the principal is repaid. If you buy a 10-year government bond, you are lending money for 10 years, receiving interest along the way, and getting your money back at the end. Simple mechanics, big consequences. Why would investors agree to this? Because bonds offer something specific, very specific. They trade upside for predictability. Bondholders don't get rich if the economy booms. They don't participate in growth, after all. But in return, they get regular payments, legal priority, and in the case of governments, a high expectation of repayment. For pensions, insurance, banks and institutions, that stability matters more than excitement. This creates a massive pool of buyers, and governments know this. Now, here is where it gets interesting. When a government issues bonds, it doesn't decide the interest rate alone. The markets do. Investors look at the government and ask, how stable is it? How credible is it? How likely is it to repay without inflating the currency away? If trust is high, interest rates stay low. If trust weakens, rates rise. This means bonds act like real-time feedback systems. No protests, no speeches, no elections required, just prices. A rising yield is the market quietly saying, we are less comfortable lending to you, and that's powerful. Governments get funding, but they also submit themselves to discipline. Not from voters, though. but from capital. This is why bonds are not just financial instruments. They are governance tools. They allow governments to borrow at scale, retain full control, and receive continuous signals about credibility. Stocks would fragment power, taxes would trigger resistance, money printing would destroy confidence. Bonds thread the needle. But bonds are not risk-free. They carry risks that are easy to ignore. There is credit risk, the chance that the government can't or will not repay. There is inflation risk, the risk that repayments lose real value. And there is interest rate risk, the risk that market rates change after issuance. These risks don't show up all at once. They accumulate quietly, which is why bonds often feel safe, right up until they don't. This brings us to the deeper truth. Bonds are about time. They move cost across decades. They convert uncertainty into contracts. They let governments trade future obligations for present stability. That is not good or bad by default. It's infrastructure. And like all infrastructure, it works until it's pushed beyond its limits. A bond is a loan. Governments love them because they fund spending without selling control. And markets decide the price of that privilege.